Hello. Hello. Yes, good afternoon, everybody. I hope you can hear my voice and also see my screen clearly. This is 7th of September. So I want us to look at some of the patterns which are very, very useful, especially when you want to trade the Forex market. These are some things which you already know them. Some of them we already discussed them in the previous webinar. We just want to build on what we already know. So the first thing is there are a lot of price patterns that if you want to master all of them, you'll actually get confused instead of understanding something. So we'll focus strictly on those that make sense, those that, not that the others don't make sense, but those that we tend to see most and those that we tend to follow up most on. So the first shape, or the first pattern which I normally look for is I look for the flag formation pattern. The first pattern which I normally look for is I look for the flag formation pattern. So the flag formation, as the name suggests, is some pattern which looks like it's forming a flag. That's what I look for. So that means you look for something like that which shows you a sign for either a sell or a sign for either buy. So I'll draw it on the screen. Assuming you have price move up in this manner, like the price goes up and then it pulls back down, then it goes up and then it pulls back down, something like this, then it goes up like that, and then it pulls back down like this. So you see that the price is going up, it attempts to go up, down, and then it comes back up. We see something like this. Then the price goes up, down, something like this. So you can see that the previous uptrend which we had, which is moving nicely upwards, this one here, is somehow being interrupted around this area here. So you draw a line touching the line at the top like that, and then you draw another line touching the line at the bottom like this. Then the two lines which you've seen, these two lines here, now are meaning that this is what is known as a flag. So it's a pattern which forms within an active trend. So when the price is upwards as it is now, you can see that the price is upwards. It enters into some range where it does not break above this level or it does not break below this level. If the price should ascend and close above this level, this trend line here, then that is a break of this flag here, which means the price should now continue to the upper side. Anytime you have a formation like this one, where the price was in a very good uptrend, then it ends up entering inside some to see price either break above this line or the price may break below this line. Then we pick a position. This is the first pattern which we look at. So the same thing could happen when the price is downwards. That is when you have something like this, maybe the price breaks below this one and then it pulls back upwards, then it goes down, and then it pulls back upwards, and then it goes down, then it pulls back upwards, something like this. So it goes up, down, then it continues down, maybe like this, then it begins to consolidate. So it goes up, then it goes down, then it goes up, and then it goes down, and then it goes up, then it goes down, something like this. So whenever the price is in a downtrend, then something like this happens. That is, the price does not necessarily continue that direction, it just remains within some two to identify, draw a flag around it. So you'll draw like that, and then you draw another one at the top. Now this becomes a flag formation. You can also call it a contracting wedge formation, because a flag tends to be uniform. That is, the distance from the first touch and the first touch is almost the same as the distance from the second touch and the second touch and the third touch and the third. That makes it, that's always how it looks. It looks the same for a perfect flag formation. So this also is a pattern in its own, but it's known as the contracting wedge formation. Contracting means that we are approaching a point where the price may either break above or break below the lower line. So we just want to see what happens. If the price should descend and close below the lower line, then that is usually an indication that the price is going to continue downwards. But if the price breaks above the upper line, then it's usually an indication that the price is going to continue to the upper side. So normally when this happens and you notice that this is happening, it's getting narrower and narrower as the price progresses in the future, then just know that it's highly likely that the price may break either above or below the lower line. So you keep watching for breakout. You may see a break below this point, or you may see a break above this point. So if the price descends below the lower line, sell it, have your stop loss above this high. If the price breaks above this point, buy it, have your stop loss below the low of this touch here. Does that make sense? So we have a flag formation, we have a contracting wedge formation, and then we have an expanding wedge formation. So that's where the price is upwards. You see that the price is continuously moving upwards. It goes up, and then instead of contracting, it begins to expand. So you just notice that somehow the price is moving up, and the more it moves up and down, the more it expands from where it was. So you look at where it touched the first time, you draw something like that, and then you also draw something like that. You can see that this is purely an expanding formation. So this is a very good place to look for a sell from. You either wait for a sell from the top or wait for buy from the bottom. So you can sell it, you can buy it there, or wait and sell it there. This is still another very good price formation pattern. And all of them, you look for one thing. If the price descends and closes below the upper line, above the upper line, that indicates that we are now continuing upwards. And in case the price closes below the lower line, then that will indicate that the price is going to continue to the lower side. I hope that makes a lot of sense. I hope that makes a lot of sense. So these are some of the most useful price formation patterns that you should be looking at. First of all, look for expanding wedge formation, look for contracting wedge formation, then look for flag formation. So flag could be this one, or it could be in a downtrend. Either way, they still mean the same thing. They still mean just the same thing. So the other pattern which you're supposed to look at is rectangular formation or triangular formation. So rectangular formation is where the price goes into some two lines, then it begins to consolidate within those two lines. It fails to break above it, it fails to break below it, then it fails to break above it, and then it fails to break below it. It does the same thing, and then it continues to do the same thing as the price progresses into the future. So when you see, anytime you see anything like this, that the price is not actually moving upwards, not breaking above this line, at the same time it's not breaking below this point, but these lines are ending around the same place, then just know perfectly well that that's a very good place to trade reversals. So your job will be basically to wait for price from around these two lines. If the price gets above, you buy it. If the price gets below there, you sell it. You buy from the bottom and sell from the top. If the price breaks above this line, you continue to buy it. If it breaks below that line, then you continue to sell them. Does that make sense? So you find some imaginary lines here, another one here. Then the price goes up. It still remains within that shape. Up. And then after sometimes the price actually manages to break above. So when this happens, anytime you have something like this is a very good shape you're supposed to look at. If you see anything like that forming, expect that the price will likely break either above it or below it. But if it breaks above it, it's more ideal. You wait for a retracement and then you pick a buy position. Your take profit should be fixed at this price here. So basically, this will be the best place to look for a buy from. That will be the best place you want to pick a buy from. After this breakout, wait for this pullback so that you pick a buy position here. Expect the buyers to push us upwards back to this point here. So if you're on this chart and you see this happening, expect a breakout, a retracement, and then a continuation upwards up to this level here. And in case on the other side the price descends and closes below these two lines, then expect the sellers to push price even lower. So the idea here will be to look for a sell in case the price descends and closes below these two lines here. So this webinar, basically we've just looked at the shapes themselves, the patterns themselves, but we've not looked at the actual thing on the real chart. Let's see if we can get an example of any of this so that we look at that on real time. So look at this. Look at what resistance. We had a support, we had a resistance, we had a support, we had a resistance, and then we had a break above that resistance trend line. So as I mentioned with the example which I gave, when the price goes above such a line, wait for a pullback as it did here, then pick a buy position there. The first take profit should be somewhere here. So it's almost guaranteed that the price will always go as high as the points where the price was previously touching this line here. So that would mean that if the price breaks above it, and you had this as attached, this attached, we had this as attached, we had another one as attached. This means if the price broke above, then it pulls back to this point. If you pick a buy here, the price must at least hit any of these three lines. If it hits this, it may likely hit this one. If it goes beyond this, then it's likely going even further up to the next level, which is this one here. So this is a very good example of an expanding price pattern. It shows that the price is expanding as we move into the future. My next example, let's see the other one. This look at this. Doesn't look very good, but still is a shape. So this is like a contracting wedge formation. Yes, this looks like a contracting wedge formation. You can see that we had here, and then it gets smaller. So when you see anything like this, this still is not very good. Just a second. I think we have a better one here. So this is a very good example of a contracting wedge formation. You can see we had a support, a resistance, a support, a resistance. Then there is this break on here. So as I mentioned, when the price breaks below anything like this, just wait for some pullback. Then you pick a sell position. And as we applied with the expanding wedge formation, your take profit should be at least at the instance when this line was touched. So if it was touched at this point, just know the price must at least come back up to that point there. That's what I've done here. So thank you very much. I want us to remain with those few examples. That is what I wanted us to have a look at today. So next time I want us to build on more examples. We'll basically just be looking at examples of perfect price actions, cases where these shapes formed and they were used very well for buy or sell or for very good trades. So thank you very much. See you again next week at the same time. Thank you.